You said this is about hidden characteristics before the deal happens.
Exactly. It occurs when, before a transaction, one party has crucial information about the quality of the product, service, or even themselves that the other party lacks. And this leads to a situation where the wrong type of product or person is disproportionately selected in the transaction.
The wrong type, meaning the less desirable ones.
Often, yes, the ones offering the lowest return or highest risk to the uninformed party. A key consequence can be missing markets, where potentially good trades just don't happen because of this information problem.
Okay. And you mentioned ways to fight this, signaling and screening.
Right. Signaling is when the party with the hidden information takes credible steps to reveal it. Screening is when the party without the information sets things up to try and force the other party to reveal it.
Okay, let's use the classic example. Used cars. The lemons market. The seller knows if the car is secretly a piece of junk, a lemon, but the buyer doesn't.
Perfect example. George Akerlof won a Nobel for this work.
So the buyer suspects they might get a lemon. What happens? They offer a lower price.
Exactly. They offer a price that reflects the average quality, accounting for the risk of getting a bad car. But that average price might be too low for someone selling a genuinely good car, a gem.
So the good cars get pulled off the market.
Correct. The sellers of gems say, nope, not selling for that low price, which means the cars actually left for sale are disproportionately the lower quality ones, the lemons. The market for good used cars might shrink drastically or even disappear. Mutually beneficial trades, a buyer willing to pay a fair price for a good car, don't happen.
So how do buyers and sellers try to fix this in the car market? Using signaling and screening.
Okay, so screening. The buyer, an informed party, might insist on getting the car checked by an independent mechanic before buying. That's an action to uncover the hidden information.
Right. And signaling.
Signaling. The seller, informed party, of a genuinely good car might offer a warranty or a guarantee. This is credible because offering a warranty on a lemon would be incredibly expensive for the seller. They know it'll likely break down. So the warranty signals quality.
Makes sense. Is there a government role here too, like lemon laws?
Yes, many places have them. Singapore's Consumer Protection Act, the CPFTA, includes a lemon law, effective since 2012. It basically says if a defect shows up within 6 months, it's presumed to have been there at the time of sale, unless the seller can prove otherwise.
Ah, so it shifts the burden.
It does.
Yeah.
It gives consumers recourse if they buy faulty goods. This protects buyers, makes sellers more honest about quality, and helps prevent adverse selection from killing the market for decent products.
Are there downsides to lemon laws?
Well, there are potential costs. Buyers might face transaction costs, trying to make a claim. Authorities have enforcement costs. And there's always a small risk of consumers abusing the law, claiming defects that weren't really there at purchase.
Okay, let's take adverse selection to insurance again. Health insurance. People know more about their own health risks than the insurer, right?
Definitely. Someone who suspects they have health problems or knows they engage in risky behaviors is much more likely to want to buy comprehensive health insurance.
So the people most likely to buy are the highest risk.
Exactly. This drives up the average cost for the insurer, who then has to raise premiums for everyone.
And then the healthy, low-risk people look at the high premium and think,
oh, that's not worth it for me. So they drop out of the market. Again, you get underconsumption by the low-risk group, and the insurance pool is skewed towards higher-risk individuals. Deadweight loss.
So how do insurers try to screen for health risks?
They use medical questionnaires, sometimes require checkups. Based on that, they might charge higher premiums for higher risks, or even deny coverage altogether. That's the cherry-picking problem, where private insurers might avoid covering the sickest people.
Any other screening tricks?
Offering different policy types can work. Think car insurance. A policy with a low premium but a very high deductible might appeal more to safe drivers who don't expect to claim often, while riskier drivers might prefer to pay a higher premium for lower deductible. The choice itself reveals information about perceived risk.
And what's the government solution for health insurance adverse selection?
Compulsory participation is a major one, like Singapore's MediShield Life. Everyone has to be in it. Citizens, PRs. It covers you for life, even with pre-existing conditions.
So you force everyone into the pool.
Exactly. It achieves universal risk pooling. The premiums paid by the young and healthy help offset the costs of the older and sicker individuals. This keeps basic insurance affordable for everyone. CareShield Life for long-term care works similarly.
Sounds effective, but are there limitations?
Sure, these universal schemes require significant government subsidies, especially for lower-income groups, which means taxpayer money and an opportunity cost that money could have been spent elsewhere. And there's small risk people might end up with more basic insurance than they'd personally choose if it weren't compulsory.
Okay, two more quick examples. Labor markets. Workers know their own productivity better than potential employers. Adverse selection there.
Big time.
Yeah.
Imagine a firm wants to hire bag makers, but can't tell who's fast and who's slow. So they offer an average wage.
What happens?
The really productive workers, who know they're worth more than the average wage, might say, no thanks, and go elsewhere, or work less hard. The less productive workers are happy to take the average wage.
So the workforce quality declines.
Right. The firm ends up hiring disproportionately less productive workers. It's adverse selection, and it can be self-reinforcing.
How do firms screen or signal here?
Education is a common signal. Getting a degree is generally harder for less capable individuals, so firms use it as a proxy for productivity. That's signaling by the worker.
And screening by the firm.
Aptitude tests, trial periods, internships. All ways for the firm to try and observe productivity directly before committing to a long-term contract.
Last one. The market for credit. Borrowing money. Lenders don't know for sure who will pay back.
Another classic Lemons problem. Borrowers know their own financial situation and repayment intentions much better than the bank or credit card company.
So if the lender charges a high interest rate to cover the risk of default,
It drives away the good borrowers. People who know they are very likely to repay will find the high rate unattractive. They'll look elsewhere or won't borrow.
leaving mostly the higher-risk borrowers willing to accept the high rate.
Exactly, which increases the lender's risk further, potentially pushing rates even higher. Adverse selection strikes again.
And the screening mechanism here.
Collecting detailed information, credit scores, income verification, employment history. Banks invest a lot in this screening process to try and differentiate low risk from high risk borrowers. It's crucial for the market to function.
But privacy concerns.
Yes, that's the trade-off. The need for information to make the market work versus individuals' right to financial privacy.
Wow, okay. That's a lot on information failure. So just to recap quickly, moral hazard, hidden actions after the deal, like being less careful when insured.
Right, because you don't bear the full cost.
Adverse selection, hidden characteristics before the deal, like only lemons being left in the used car market, or risky people being most eager for insurance.
Precisely. Both stem from that information imbalance, that asymmetry, and both lead to inefficient market outcomes or market failures.
So the big question then, does the government always have to jump in when these problems pop up?
Not necessarily, no. As we saw, sometimes the market finds its own solutions through signaling and screening by private parties.
Okay.
And it's crucial to remember governments usually don't have better information than the people actually involved in the transaction. Their knowledge is often imperfect, too.
So intervention might not be perfect.
Exactly. Government intervention is often needed, but it might only achieve a second-best outcome. Better than the market failure, perhaps, but not the theoretical perfect ideal. There are trade-offs.
This has been incredibly insightful, understanding factor immobility, and especially these nuances of moral hazard and adverse selection. It really does give you a much sharper lens for looking at economic news, government policies, just the world around us.
It moves beyond the simple supply and demand curves, doesn't it?
Yeah.
Into the complexities of real-world behavior and information.
Definitely. Which leaves us with a final thought to ponder. If we know perfect information is basically impossible, and even government fixes have limitations and costs, what ethical responsibilities do we have as individuals, as companies, to try and bridge these information gaps ourselves? To act in ways that foster more efficient, maybe more equitable outcomes, even without a specific rule forcing us to, beyond just waiting for regulation.